Our next guest is a fund manager with a very unique mandate. Paul Carmel, president of SIDEX, joins us today. Paul, welcome to Kitco. It's a pleasure to speak with you.
Hi, thank you, David.
Before we talk about SIDEX and your fund, let's talk about your gold price outlook. We've seen all-time highs this year. Are the factors driving it up earlier in the summer still alive today?
I think definitely. I think there's more to come as well, David. I mean, as long as the spending packages are announced and, the printing presses keep rolling, I think gold will be underpinned by some pretty solid fundamentals. The whole COVID thing plays into it. Once that gets settled, and it will, gold might take a breather, but I think, the structural forces underpinning gold will continue to march forward. And, I think gold's in a long-term uptrend here.
What was interesting this year was we saw new demographics of investors, particularly young millennials, rushing into the gold space, whereas they hadn't before on trading platforms like Robinhood. They were chasing momentum, but more or less they've kind of tapered off now. Do you think that gold will still sustain this momentum without this new money?
Well, I think definitely. I mean, don't forget, gold is a pretty small market, David. I mean, the U.S. currency, big currencies of the world are, they're much larger than gold. Gold's a relatively small market, and you don't need a mass exodus, from currencies into gold to create a major move. When you just need basically a small shift, and gold being the small market that it is, the gold, the door becomes very small, and it doesn't take much to create a substantial move. So as long as there's a fear out there of the U.S. dollar losing its store of value and its world sort of currency. If you start talking about debasement of the U.S. dollar, I think that is, significant ammunition for a move in the gold price, and that's what we're currently experiencing right now.
Do you think the U.S. dollar will continue to devalue?
Well, you always have to compare it to another either currency or asset, but I think it will be under pressure given the issues they have down there. I mean, they're under some huge challenges, be they political, socially, or fiscally. They're under some huge challenges, and I think that will probably not get solved in the near term.
As a fund manager, how do you view gold as an asset? I've heard different things. I've heard gold being used as a commodity. I've heard gold being traded as a currency. I've heard gold being traded as a hedge. So what's your philosophy here?
Yeah, well, it's all those things, right? But I mean, gold really is probably more than anything is viewed as a currency, a portfolio balancer, an insurance policy. Call it what you will, right? So, central banks will own it to balance out their portfolio. But I think in that respect, it's kind of viewed as a proxy, safe haven proxy in a time when currencies are being debased.
Right. So you're a fund manager. We're going to be talking about your fund in just a minute, but you're mostly invested in junior miners. So you're not one of those managers who has the 5 or 10% weighting in gold. You're all in gold, technically speaking. So then, important drivers for your fund. What are you looking for? What are the biggest risks?
Well, just to correct you, we're sort of all in, and you're correct in saying that we're all in exploration companies. But those exploration companies will either explore for gold or base metals or strategic minerals, whatever is in the province of Quebec. And companies are exploring for. That's where our exposure is. But it is primarily gold. You're correct. And I think that's reflective of where most of the exploration dollars are going. Also on a world platform is going into gold these days as well. It's been the top performing commodity, really.
So what are the biggest macro forces that are impacting your fund right now? What are the biggest risks that you're looking out for?
Macro factors. I mean, right now we're in a bit of we're enjoying after, almost a 10-year bear run here. We're enjoying some pretty good times in the province of Quebec, because Quebec is being viewed as one of the more prized jurisdictions to be exploring in. And so we are, there's companies exploring for Quebec and gold and base metals and just about everything. It's become a province of choice, I guess, in Canada, but also a jurisdiction of choice on a world basis. And so, our fund right now invests in companies that explore in the province of Quebec. I mean, they don't have to be based there, but as long as they spend their exploration dollar in Quebec, then they're part of our mandate.
So why did you choose this mandate? You're one of the few fund managers I've spoken to who have, well, actually the first one I've spoken to who has a mandate of investing only in operations in Quebec. Why this jurisdiction for you?
Well, to answer that question, it's helpful to go back. I mean, 20 years ago, our two founding institutions, the Fonds de Solidarité, FTQ, and the Quebec government, very smartly realized that in order to have a very healthy mining industry, you had to take care of the front end. You had to take care of the exploration sector. And so they created this fund by a $50 million injection of capital, created this fund and staffed it. And for 20 years, we've had this dual mandate of, number one, earning a return for our investors, which we have, but also, providing some oxygen to the exploration companies. I mean, over the course of 20 years, the stock market will ebb and flow. Capital is not always available, but SIDEX is always ready to invest in exploration companies, good times and bad.
Okay. So let's talk about the performance of the fund now. It's mostly, it's driven by the performance of the local companies in Quebec. A lot of investors would like to know how the region has performed.
Right. Well, let me give you an idea. I mean, the $50 million that was injected 20 years ago by our limited partners, since then we've returned 16 million, leaving a net, money at play of 34 million. And our fund today is valued at about 95 million. So it's almost a triple in that sense. So when you look at it, it's, in my opinion, I'm a little biased here, but it's quite impressive given that, we're obliged to invest in companies only operating in Quebec, and we're obliged to invest in exploration companies. So, our universe is quite small. And despite that, we managed to earn, a substantial increase in capital.
If you take a look at the beta of Quebec mining companies to the rest of the index, do you think there's a huge correlation between Quebec miners and, let's say, the GDXJ, or do you think the sector in Quebec is relatively insulated from larger market moves?
Well, I think the beta is probably similar, David. But I mean, when you look at the beta of the universe that we invest in, it's very high. I mean, you can't get much more of a riskier investment than a junior exploration stock, which is also another compelling factor why our fund has done relatively well. We have to be quite disciplined. We have an active management in our fund. So yes, we do primary investments, but we also manage in the aftermarket as well. But yeah, very high beta. But I wouldn't say that the beta of those companies in Quebec is all that different than exploration companies elsewhere. But it is a higher risk end of the investment spectrum for mining plays.
How many securities are in your portfolio?
So right now we have 55 companies, 55 exploration companies, but we invested in about triple that over the course of the 20 years. We've probably invested in 150 companies. We have sold some, we've bought some, but right now we hold about 55 companies.
Okay, and you talked about risk earlier. Like you said, it's a high beta industry. Is there a hedging strategy that you use? How do you mitigate risk?
We don't use a hedging strategy. I mean, it's very hard to kind of develop a hedge. We're a long only fund. I mean, we're not a hedge fund. We're just basically purchase securities of junior mining companies. So yeah, there's no embedded hedging strategy in our fund.
Well, I think a lot of retail investors who are watching now who will be interested in replicating something similar, what would you advise them to do? How would you pick a stock based in Quebec? What are the factors that you look for?
Well, that's a good question. I mean, we have a pretty experienced group. I've been in the business 30 years, but my colleague Isabelle Cadieux has been doing this from the very beginning, 20 years. She's an experienced geologist, 35 years experience. We've just hired another individual who has André Laferrière, who has 25 years experience. So, when mining companies come in to see us, geology, exploration companies, and start talking about their geological perspectives and their plays, we pretty much know how to analyze them and how to ascertain the value there. So I think it would be relatively tough for a retail investor to replicate that. But we've done it quite successfully over the last 20 years.
Let's talk about valuations now. You mentioned you had more stocks in your portfolio, but you sold some of them off. So do you think that the sector can continue to see value growth?
Mm-hmm. Well, just to be precise, we have taken some money off the table. We're also in there buying as well. We have a pretty active, portfolio management approach in our fund. But to answer your question, I mean, yes, we've had a pretty good move in a lot of these plays. After a long drought in the sector, we've had a pretty good upward move. And I've been in the business long enough to know it's a cyclical business, and it doesn't go up forever. But there could be a bit of a breather. It's not to say that it won't continue or go much higher. It's just you just don't know. So I think you have to be pretty disciplined about running a portfolio of exploration companies the way we do.
Okay. Now, do you think that short term, the junior mining sector as a whole is a little bit overbought?
It could be. Anything that's moved up. If you look at a chart on any one of these companies, they've gone up, pretty substantially. Gold has had a good run. And it's had a good run in U.S. dollars, but it's also had a tremendous run in Canadian dollar terms. I was a gold analyst for 10 years, and in those 10 years, the gold price, ranged between $260 and $400 an ounce, and it's trading close to 2,000 today. So it's a pretty lofty level, and if you price it in Canadian dollar terms, you're at $2,500, $2,600. Mining companies can make some pretty good money in here. It's not to say it won't continue or go much higher, but gold price is a very difficult commodity to forecast. So you have to be disciplined. You have to know when to buy low and take some off the table as it moves up.
Okay. Is holding cash an important aspect of your portfolio? Because if you're dealing with a lot of junior miners with relatively small market caps, liquidity might be an issue if we see a sell-off. So how do you mitigate that risk?
Well, we do hold cash in our fund, quite a bit of it. So we have a lot of dry powder, I guess, is one way to put it. But as I said, we're a pretty friendly door to knock on for exploration companies. And that's really a function of why we were formed. I mean, we were formed, to be a sympathetic and a friendly door to knock on for exploration companies. It doesn't mean we're going to invest in every pitch we hear. But we will take the time to look at the companies, to hear the story, because the other part of our mandate is to be a source of oxygen and capital for the Quebec mining industry, and that's another part of our mandate. We have to help stimulate exploration in Quebec, right? So we will always be ready to listen to anybody who wants to, start a drill program or acquire a project. Or in Quebec, we're a very open and sympathetic door to knock on.
So we've heard about the theory of peak gold, which is, I guess, a global theory which extends to all corners of the world. Let's talk about Quebec in particular. How do you feel about the supply side of gold and base metals in Quebec? Do you think we're seeing scarcity, or do you think there's a lot more supply yet to be tapped?
It's a good question. The answer is scarcity, right? I mean, and it's not just in Quebec; it's on a world scale. And it's an excellent question because, I've been in this business 30 years, and the low-hanging fruit has been found, right? And it's just getting tougher and tougher to number one, find deposits, but it's also getting tougher and tougher to mine them. We live in a world now that it's just, if you have the good fortune of finding a mine, it's very difficult to actually get the required permitting and the socio-political license to put it into production. The whole supply side, to me, is under threat. And the last time I checked, the world was still getting larger and more populous, and the demand side marches on. So eventually it's going to be time to pay the piper. And so I think it leads, in my mind anyway, that the next commodity cycle could be quite dramatic.
Finally, what kinds of mistakes would you advise new retail investors coming out of the space to avoid? You're an experienced fund manager. What have you seen done wrong from the investment side?
That's, I mean, nobody's infallible, but it's a tough question to answer because mining is a fairly difficult space to analyze. And I guess what I would encourage retail investors is to do their homework as much as they can, and to do their own research, but also to read publications, to understand exactly what is behind the mining company, that in the security in which they're buying. If possible, even meet with management if they can, or have them or assist to virtual presentations like we're doing. But really do your bottom up work in the stories and not get caught up in the in the euphoria of the cycle. To really try to drill down, pardon the pun, into the fundamentals of the company.
Well, this year, following the rapid rise of the gold price to $2,000 announced, a lot of investors were expecting more M&A in the space. Can you comment on this expectation?
Well, the last time that happened, it didn't exactly end well. Okay, so I think a lot of the boards of directors of companies are, advising their management teams to, don't get caught up in M&A frenzy, because the last time that happened, it resulted in a lot of bad deals. So I think this time, the watchword is, let's grow generically, let's grow by the drill bit. And yes, I mean, if you're going to do a deal, make sure that you're not betting the farm on it. So yeah, you're right. I mean, in this upcycle, we haven't seen as many. We probably will see some, but we won't see the massive deals that we saw in the past, I don't.
You mentioned a good point, which is the mistakes they've made in the past. Do you think the sector as a whole, when you're looking at management, do you think they've learned from those mistakes from 2011?
Well, I think so, but managements change as well, right? And mining companies, it's very hard to grow. Like we said before, the low-hanging fruit has been found with new discoveries. So, mining companies are under increased pressure to grow. And when you can't find things, when you grow, what do? You buy things. And that's what leads to M&A, activity. And so it's very hard for a company to go by a year, 2 years, 3 years without actually growing and getting bigger, because their boards are after them, their shareholders are after them. So what they end up doing is buying things, and that always doesn't prove to be the best way to grow and to add value. So to me, the best way to add value, it's the hardest way, but the best way to do it is to actually, through the drill bit, find discoveries and grow like that, like they did in the old days, I guess. That's, I think, the way to go.
Okay, perfect. Thank you very much, Paul. I appreciate your thoughts today.
All right, David, thank you.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more.